Charles, I want to thank you for taking the time today to go through and really have a discussion about a new inclusion that you've brought into the portfolio, Carnival Cruise Lines or Carnival Corporation. I mean, with what's happening in the markets right now and the crash that we've just gone through with the COVID and the price of oil and all this sort of stuff, it's caused havoc in the market. However, where that havoc is present is also creates opportunities, and so I think really talking about this opportunity and why you included it in the portfolio, I think would be a great discussion. So maybe I'll just pass it over to you and you can just share with me your sort of review of Carnival and why you've included it into your top 20.
Well, as you said, we're sitting in the middle of a massive sell-off, not from an economic point of view, but because we all have to, stay away from business and do things. And we've seen the whole market come off with a mighty crash. And there are some areas that have been more devastated than others. And certainly the travel and leisure area has been hammered. The resources have been hammered, and the airlines and most of the things have been hammered. We like the situation where everybody's running out the doors and everybody's panicking. And then we like to go through everything and see what is an uptick and what do we feel is trading under valuation. And we say all the time that 60% of the return is based on the valuation, not even the company to that degree. So I'm going through everything. I'm looking at Carnival, and Carnival was at $72 and fell down to $30 in 3 or 4 days as the market came off. So I looked at Carnival and I looked at the airlines and I looked at other areas that might be of interest, and the airlines weren't of interest for me for other reasons. So I looked at Carnival and decided that the company's sold off at 80%. Now we know that it sold off for a reason. And we know that people aren't going back into the cruise. They're not going to be making reservations on cruise ship next week or next month. But the idea is that we want long-term value. And given the earnings and given what Carnival's able to do, we're looking at a 300 or 400% return. Now, if that 300 or 400% return takes 4 or 5 or 6 years, we don't care. We're just looking for really good businesses at a cheap price. And we very rarely get into a situation that the valuations have dropped so much. It's been 12 years really since 2008. So I decided that we want to buy Carnival. So you can see at the top left, Carnival was 50, but if you go back a little bit over there, it's like $72, and it's just got absolutely hammered. And when we look at valuations, we look at certainly return on invested capital is important, and they're at 7%. We look at the price to economic book value, and really what the market is saying is this company will never survive and will never make any money. So when we look at the price to economic book value, it's the same with all the businesses that we buy. And another interesting point is that the Saudi Arabia sovereign account bought 50 million shares of Carnival down around here. So we've got lots of support for it. We've got a really cheap company and a high quality company. And we'll keep looking to see if we can upgrade the kind of companies given where the market is.
So that's interesting. So you can, if you just scroll up a little bit, so there's some items on the page here, which I think are quite interesting, because if you take a look at, this company, Carnival being, one of the biggest cruise line ships in the world. And I see the volume where the price drops and suddenly the volume is just through the roof. And so clearly there's a lot of opportunities that people are recognizing. But then you compare this against what's been happening to the markets. And, obviously this is where the cherry picking comes in, because you see the price to economic book value at, what is it at? 0.2.
0.2.
0.2, and the S&P you've got there at 2.5. So what that means, I'm assuming, is that, this is a company that's value, the price is so far below the value of that company, that it's tremendous opportunity. Is that a fair assessment?
Yes, the point at one, anything below one on the price to economic book value means the company won't make any cash for the future of the business.
Right. Yeah. Okay.
So at point two, we don't usually see certainly point two or point three or point four or point five, unless we have a particular maybe headline risk or because of the whole market. So obviously, when the whole market comes down, there's a lot more, there's a lot higher quality and more companies to choose from. But on the other hand, is if you decided that what fell more than the oil industry, so it doesn't mean that you're going to go and buy an oil company because it went down 90%. We still have to look at the quality of the company, the business, and the moat around it. So a lot of those oil companies are going to go under and they won't be able to come back. A lot of the retail companies, looks like Neiman Marcus is going under, JCPenney's going under, Macy's is trading at around $4. So yes, we look at valuation, but we want a business that has a good future and a good moat behind it, which is Carnival and which are all the companies that we own. Now we notice, you see the retail companies have been down 50, 60, 70%, and Walmart is making new highs. It's because of the moat.
Yeah,
People are going to keep buying from Walmart.
Yeah, it makes total sense because, just because something's gone down in value doesn't mean it's actually a worthwhile investment to make, because there could be a systemic problem that just won't be recoverable for that. But with a company you're saying like Carnival, the reality is between now and 5 years, people will probably start going on cruises again. And
well, I noticed the CEO made a statement that they're already booking for July. Now, there's some people that would go in July. There's some people that are don't take 6 feet distance to degree. But we know that Carnival's a fantastic company, and there's a moat around it. So we're not looking at bankruptcy. We're looking at holding on to this business as long as we see that the company has a good moat and a high return on invested capital. But that's not with all companies. So a lot of companies, it's really called a value trap. So just because a company drops 50% doesn't mean that it's going to go up 100%.
Yeah, right.
It just means what's the moat of the company. So is Carnival going to go out of business? No. Is Carnival going to increase business? Yes, because what they'll probably do is expand and use an opportunity to buy other companies.
Yeah, which speaks to the level of management that is high quality management that can take advantage of the economic climate to further the company's share price. Yeah, I totally see that.
Well, as Warren Buffett says, you have to wait to the tide to go out to see who's swimming naked.
Right. Yeah.
So if you've got money and if you've got a company, look at whether it be Walmart or other companies or Carnival. Okay, you've got cash, you've got money, you've got a great balance sheet. Okay, now everybody else is suffering. Okay, how can we expand our business?
Yeah. It's good business decisions to make at the right time. Yeah, I'm just amazed. I mean, with what's happened, I think in our lifetime we see opportunities like this maybe 3 times, maybe. When you see a price to economic book value ratio here at 0.2, I don't know how often in your lifetime you've seen great companies come down to a 0.2, calculation. So I just look at this and think, realistically in our lifetime, this is one of the few opportunities that we have to fully take advantage of a great entry point. Whatever that entry point is.
And what really influences people is the fact that because they're looking at it and they're seeing the market go down and prices go down and the market's crashing, and people on television are saying it's all over, it's finished, democracy's done. They're running for the hills, where people who understand valuation, it's when was the last time we could do this?
Well, that's what I'm saying. Yeah,
really,
I mean, when you know,
this is important, right? But it takes an extraneous event. Usually, it's a recession, and a lot of times, clients of mine have been through a recession and they didn't even know they were in a recession.
right?
And then we have big recessions like 2008 caused by an extraneous event. This is something that has not happened in my lifetime, where everybody stays at home. Look at the pollution and the CO2 levels around the globe now. Fantastic.
Yeah, they come way down. I know, and
people in India can see the Himalayas now, and they haven't for 40 years.
Yeah, right. Yeah. Well, it's so interesting. I mean, because there are some benefits, some positive byproducts that will come of this, and I think there was no way. I think and we're kind of getting off topic of Carnival, but we're getting into the topic of sort of what becomes potentially a new normal going forward. And when you've got, how else could any world test, okay, everybody just stay inside for a month to see what happens.
It's never happened.
It's never happened. It will probably never happen again. But the reality is that with this, there's so many things that now we can see what the reality of the results are going to be. And as a result of that, we've got, the pollution is going to be, better understood. How to manage that is going to be better understood. People's views of the workplace are going to be better understood. Now people recognize how much work can get done from a home office, whether they like it or not. It's now factoring into decisions. And anyways, I think the new normal is going to be interesting to see what happens. But I feel, and you correct me if I'm wrong, that the issues that we're facing right now, we've got the trying to contain the pandemic that's out there. That eventually will get contained. Every other pandemic in history has been contained, and so this one won't be any different. Just a matter of time. And the price of oil being down this low, it can't maintain that. It can't continue at this rate, being down this low. Once people go back to work, and once companies are allowed to start operating again, they can take advantage of the fact that prices are pretty low. When you've got, I'm thinking of a company like Carnival. Think about how much their costs are impacted by the price of fuel. Well, with prices down this low, is that not a kind of a tailwind to this?
Well, you think of all businesses globally that are paying. Look at Japan. What do they pay for oil? They have to import everything they get, and now they're buying it. You cannot escape, whether you're looking at a business, whether you're looking at buying a business, you're looking at the economy. You can't escape supply and demand. And when we saw oil go into negative on the May contract, it's because there was so much oil, because everybody's pumping oil and they want to get their price for it, and they want to get their, they want to sell their product. So it becomes so much oil that all the tankers are full, the pipes are full, everything is full around the globe. So the people that had to take delivery of the oil couldn't, because there was no place. So they had to pay, instead of you getting it, you had to pay someone else to take it away. It's because there's so much supply. And there's so much supply. Why? Because Saudi Arabia and Russia and the U.S. are pumping out so much oil. Well, we know eventually supply and demand have to come to congruency. And that's what's happening in the oil market. So in 6 months or 8 months from now, you're probably going to see oil around $45. But still, still the moat around oil is dissipating. It's like coal.
Yeah, right.
Hydrocarbons. People don't like hydrocarbons. So yes, oil is down, but it's down for a particular reason. And when you do the deep dive on it and you see supply and demand,
right.
And there's just so much supply and there's absolutely zero demand. So something has to give.
Yeah, no, I hear you. Well, that's super interesting. And I'm really, I always find it very interesting to have the conversation, to be able to take a look at the actual numbers, because you know the numbers. And when you know the numbers, you can identify the opportunities. Clearly, this is an opportunity that you've identified, and I can clearly see that by the numbers. So, I really appreciate you taking the time just to kind of review that. It's in everybody's portfolio now. And then you were saying that as you start doing some rebalancing and tilting of the portfolio, and increasing some of the equity exposure, because that's really where the opportunity lies going forward. More of this will get included at these lower prices, which can only bode well for when we come out the other side. So I appreciate you taking the time to go through all of that.